Hey everybody, this is Brant from Wolf on Wall Street Trade, and I am going to pick up where we left off with last weekend's video. I was just about ready to go camping. We did go camping, and our campsite was invaded by mini horses, like on a desperate search for beer. It was hilarious. I have a little video, maybe I'll post it at some point. But in any case, I'm going to pick up where I left off. If you didn't see last weekend's video, or if this is your first time watching one of my videos, I'd recommend just going back and looking at that. And you'll see where things were left off, what we expected, how things turned out. There's a lot of concepts and resources that are there for you in this knowledge as we kind of just move forward with this almost the market diary. But in any case, this is where we left off last weekend, and we had this bullish ascending triangle in the S&P. And what I'd said the prior weekend, last weekend's video, was that I was glad that the market didn't break out last week, the holiday shortened week of Thanksgiving, because volume would have been so low. It would have been very, very difficult to determine whether it was just seasonal low volume or a weak breakout. So if we roll forward this week, the thing I said I want to see was the averages make a higher low and then break out. So if we roll forward into this week, what you'll see with the S&P 500 here is exactly that. Confirms this trend line of this ascending triangle, which is a bullish triangle, our bullish consolidation continuation pattern. And there's the breakout right there on Wednesday, and good volume on that. Now it did get hung up right here at the 4100 level, which is a little local area of resistance from September. But let's just keep walking forward, because a lot of things happened this week. We had a lot of inflation data, we had the Fed, a lot of Fed members, we had Chair Powell speaking, and then we had the key jobs report Friday morning before the open. So this is kind of how we ended off the week. This is the jobs report right here, this kind of dip. So one of the themes we got this week is manufacturing is slowing. Manufacturing jobs are being lost. We first got the first kind of hint of inflation breaking in commodities in mid-June with this special indicator I use, basically the copper gold ratio. Mid-June, it showed inflation breaking in commodities. And then since then, we've had the CPI report, Consumer Price Index, the PPI, Producer Price Index, and this week, the Fed's preferred measure of inflation, the PCE Index. All of them are showing that inflation is starting to roll over. It's still exceptionally high, but you always look at economic data like this in terms of like month over month or quarter over quarter or year over year on a rate of change basis. That is where you really get the solid information. So inflation is still very high, but if you look at it on a year over year basis, that rate of change is starting to roll over. The big breakout here on Wednesday was Powell. Okay, so everybody was a little concerned that Powell was going to do the same thing he did at the last FOMC meeting, which was talk the market down. Because when the market rallies, it loosens financial conditions. They're tightening financial conditions to fight inflation. So the market rallying is actually loosening them, and the fear was that Powell would talk the market down. He didn't really say anything new. To be honest, he wasn't overly hawkish or overly dovish. He just wasn't trying to talk the market down. And I think the key passage, I'll put it up on the screen, was basically a recognition that monetary policy operates with a lag, usually 6 to 9 months. So what we're seeing in the economy right now with tightening of monetary policy, that's from the rate hikes in March. So the most recent ones we won't see until the middle of next year. So basically Powell was saying, we think we have enough rate hikes in the pipeline now, and we're starting to see inflation roll over. I'm not even sure if he said that, but we are starting to see that they don't want to over tighten and put the economy into a worse recession than they're already going to put it into. So here's the little quote up on the screen. Hopefully you can see all that, and if you need to, pause the video. Otherwise, I'm going to move on here. And I should also mention that right now the Fed is in media blackout, so they can't say anything more to the media. They do tend to leak to the Wall Street Journal, even when they're in blackout. So if they want to get a message out, they would do it that way, but you won't hear any more Fed speeches for the next week and a half, basically. So the market is basically just going to create its own narrative. The payrolls report was a big thing this week. And the gist of that was consensus was expecting 200,000 jobs added That's in the establishment survey. 263,000 jobs were added, so it blew away expectations. Wage gains were expected to come in at 0.33%, 0.3%. They came in double that at 0.6%. But as I mentioned in the video a month ago today, there is a huge dichotomy, a huge divergence between the establishment survey and the household survey. There were so many inconsistencies in this report, I could spend half an hour just talking about the report. But basically, usually they get about a 75% response rate from the people they reach out to get the establishment survey. This time, I think it was like 49%. So about a third of the whole payrolls report was basically just modeled on a spreadsheet. The unemployment rate stayed at 3.7%, which is near a 50-year low. But the reason why, and this is gimmicky, there's a lot of gimmicks in this report, is that 138,000 people dropped off from the labor force. So if those people were still in the labor force and unemployed, the unemployment rate would have gone up. But now they're not counted as unemployed because they're not looking for a job anymore. They've given up. But the real kicker is that while the establishment survey showed 263,000 jobs added last month, the household survey lost 138,000 jobs last month. It makes no sense. Same thing happened the month before, and in fact, it's been a trend from August. So this is from the payrolls report, the jobs created since March of 2002 in thousands, right? There's the establishment survey. There's the household survey. I mean, it's just ridiculous. And everybody knows that the BLS is a political organization. They're not apolitical. And basically, you tell them what you want the number to be, and they goal seek it. To better show you this divergence since August, here we have the establishment survey, and here we have the household survey, which is basically flat since March. There's a 2.7 million job difference between the two. Something really fishy is going on here. And one of my first posts on Friday morning after this payrolls report came out was, this is fishy. I'm not sure if the market's going to buy this. Same thing happened last month. The market didn't buy it. Well, by the end of the day, the market didn't buy it. So if we zoom in and take a closer look, like I said, we had the breakout on Powell, resistance at 4,100 on the S&P. This is the jobs report came out before the open, so the market gapped down. But look where the S&P held support perfectly right at the top of that ascending triangle and closed the gap as the day went on. And I'll show you a little bit more about that. But that's basically the market not believing that report. Now, what we do really want to pay attention to with a bullish triangle like this is a breakout that fails. Because if you get a breakout that fails, these often turn around real fast. So it's like a false breakout or a head fake. So breakout, it'll come down here and then just drop real fast. I haven't seen any evidence of that yet, but it is something, you know, to keep an eye on. So just keep in mind the phrase that failed breakouts lead to fast reversals. So besides the price action of the S&P filling that gap, what told us that the market didn't really buy it? The more sophisticated markets, the Forex market, the US dollar, and fixed income. Here is the US dollar index on a 1-minute chart. This is Friday. This is when the payrolls report came out. So this is a very, very hawkish knee-jerk reaction, bad for stocks. Basically says, you know, the payrolls report is too strong, wage growth is too strong, inflation isn't slowing in wage growth. But then look what happens the rest of the day. Retrace the whole thing. The dollar index ended down 0.2% on the day. But the real point here is this big spike, this big knee-jerk kind of reaction to the headline print. And then when people started digging in a little bit more and seeing what was going on, you saw the dollar index come down. And the same thing happened with treasuries. So this is the 2-year Treasury future. Yields trade inversely to Treasury prices. So this spike down was a jump up in the 2-year yield. I think it was up 13 basis points. By the end of the day, it closed up just 3 basis points. So basically retraced a lot of that. And here's the 10-year Treasury future. You can see how it dropped. Yields were up 10 basis points on this big drop. And it ended down by 3 basis points. So it retraced the entire whole payrolls drop. So this is basically sophisticated markets, much more sophisticated than equities, saying we don't buy this report. This is the 10-year yield. So if you watched last weekend's video, I showed how the dollar index was acting and that it was basically foreshadowing that yields would fall more. and we have this strong uptrend, and then a break here on the CPI report, bear flag, and this is this week. So the entire curve was down between 17 and 18 basis points on the week, which is good for stocks. It's helpful for stocks, and generally helpful for the mega cap stocks. So even though we got that spike on the payrolls report on the week, we're down 17 to 18 basis points across the curve. What this is starting to look like is we've reached probably peak inflation. We're getting there. And while I'm at it, let me just say one more thing about the jobs data. This is the worst lagging indicator of economic indicators. So some economic indicators are forward-looking and they're leading. Generally speaking, the labor market won't roll over until you're already in a recession. It is not a predictor of a recession. Okay, so when people say, oh, we're not in a recession because the labor market's still strong, that's bunk, because it is the last thing to roll over. Usually we're in a recession by the time it does. In the last few videos, I've also mentioned that gold and stocks are trading very similarly, which is odd because stocks are a risk asset where gold is a safe haven. So the reason why is both of them are being driven by the same thing, which is inverse or negative correlations to the US dollar and to Treasury yields. So if you look at a chart of gold, it looks very similar to a chart of the averages. Last week, I think I showed gold futures. Let me pull those up real quick. And a base with a nice 3C positive divergence in the 1620 area. So this is gold futures with my proprietary indicator 3C here in blue, which is basically a money flow indicator. And you can see 3C is tracking down or even leading gold prices down until we get into this 1620 area right here, and 3C is positively diverging. If I roll forward a little bit, you'll see a little W base, very similar to the ones that we saw in the Dow and small caps. And then we see gold make a nice move on some volume here. You see that positive divergence right in the 1620 area. And the key next area was 1800 for gold, and gold hit and went right through 1800 this week. So gold just had its best month last month since July of 2020, coming off this base. Gold is acting like stocks. So I've said numerous times, gold will probably rally about as long as stocks rally. So when we see stocks looking like they're about ready to turn over, roll over, gold probably will too, because it's being driven by the same two dynamics. Matter of fact, if you go back to last weekend's video, you'll see I had a bull flag right over here for gold, very similar to the bullish consolidations in like the NASDAQ bull flag. And here's the breakout this week. And there's that 1800 level, which was a key level, and it held it on that payrolls report because it dipped as the dollar jumped initially and closed right back above 1800. So this is the first time I've seen gold look pretty decent in probably well over a year. I want to jump back to equities though, because I'm already seeing some what I would call disinformation from financial media. So the Dow this week was up as much as 20% off its October low. So here's the Dow on a daily chart, and here's the primary trend, downtrend. This is where we first got a hint of something going on in August, where the Dow, but more specifically small caps, really broke through this trend line. I'll show you small caps in a minute, but you can see the Dow here has gone ahead and made a primary trend higher high. So the financial media is saying because we have a 20% gain from this, we're in a new bull market. I never look at that 20% rule as being a bull market or a bear market. And the reason why is if you pull up a stock like Tesla that's got a much higher beta. So here's Tesla in a primary uptrend. And this just looks like a pullback, right? So let's measure it real quick, or roughly. It's almost a 40% pullback. So if you use that metric of 20% as a bear market, this is not a bear market. That's just a pullback. It depends on the asset's beta. So it's really just deceptive. It's not accurate. You should really be watching the primary trend. And for the primary trend, what we have is basically a series of lower highs. Sorry about this pen. It's really not my forte here with the mouse pad. Lower highs and lower lows. That's a primary downtrend. This is the first higher high right over here. So this is a transitional market, but we need to make a higher low. And I really just don't believe that this is a new bull market. Not seeing this in anything else. Let me show you small caps real quick. And here you can see the reason why in August I was telling my members I think we're going to move into a transitional trend that's going to be more sideways. Small caps really made a big breakout above this downtrend line. But if we take off the trend line real quick, what you'll see, I hope, is exactly what we were looking for. Let me see if I can do this with this pen. And that was a transitional trend is more lateral in nature. This is what I was looking for in August, or what I was suspecting we were going to see, was instead of a primary downtrend, a turn to an intermediate lateral trend, which is a big, choppy trading range. It's great for swing traders, but it's very interesting. Something I read this week is Ray Dalio's Bridgewater, which is one of the biggest hedge funds in existence, $140 billion in assets under management, lost all of 2022's gains in the last 2 months. So basically they got wiped out on this bear market rally. And I had somebody comment on last weekend's video, and I'm not trying to call them out or anything like that. It was a perfectly fair comment, but it basically said, I was talking about, I think the market looks bullish going in the next week and in the near term, maybe throughout the rest of December. And then at the end I said, but remember that this is a bear market rally. And he basically had pointed out, what you said at the end kind of contradicted your whole video. That is the point, though, that these bear market rallies are like rip your face off, strongest rallies you'll see. And the fact that Bridgewater was probably positioned right for most of the year, but then missed that bear market rally, wiped out all of their 2022 gains in 2 months. And these are what you'd call some of the smartest guys in the room, but apparently nobody there can read a price chart. So if you know anybody over there, send them a link to my website. Heading into next week, let me pull up the SP 500 real quick. What we still have is this bullish ascending triangle that broke out. It held support, but we do have this 4100 level here, which is some local resistance from back here in September. And another thing that I pointed out in last weekend's video, and I've been talking to my members about a lot, is don't get lost in the lines. Every once in a while, take the trend lines off, reevaluate price, see if there's something that you are missing. And what I'm going to do is just take off the trend lines real quick and show you the sub-intermediate trend. So here's the October low, and this was an inverse head and shoulders base that we were looking at. And if you just follow the intermediate trend, right, and you pick out the pivots here, there's a high, there's a low, there's a high. Oops, sorry, I'm really not good with this marker. Here's the low, here's the high. You can put a few more in here actually, here and here. And what you get is a pattern of higher highs and higher lows, which is the very definition of an uptrend. So regardless of the price formation that we have here, and we do want to watch that because you don't want to see a failed breakout, but regardless of that, you have a sub-intermediate uptrend that is bullish. So this is probably what wiped out all of Bridgewater's gains for the year. They probably were on the wrong side of this. They were probably long the dollar, short stocks, short bonds, and they got hit. Keep in mind this is a seasonably favorable time for the market. The Santa Claus rally, also the midterm election years tend to be better years than most. I think that this kind of could last throughout December, but we'll see as we go in the next week because we're just starting December now. But I think we need to see rotation to the mega caps, and for that to happen, yields have to continue to fall. Mega caps actually outperformed this week. NASDAQ actually outperformed this week. It was the best performing average. It's tech heavy. It's got all the mega caps. It was up 2%. And the mega cap index outperformed the S&P equal weight index by 75 basis points on the week. So that kind of hints at the fact that we're going into this new month now, and it seems like we're getting some rotation into those mega caps, which, 6 of those can move the market more than 1,000 NYSE stocks. NASDAQ's price action going into next week looks good. We had the bull flag last week. It ended right here. Was looking for a pullback and a breakout. There it is. IWM, small caps. If you saw last weekend's video, one of the things I was looking for was a pullback to a higher low. So here was where we ended last weekend. Here's the pullback to a higher low. This was the other low. So higher low and a breakout, bull flag breakout. So we do have some really good looking price charts still, very constructive. But remember, we have basically next week and then the market's going to start thinking about the Federal Reserve meeting. So we'll have next week, and then Monday, Tuesday, then the Federal Reserve meeting. I'm going to show you just a few positive, what I call market signals. Some are my indicators, but some are just market signals. So I'm going to show you a few of those. So remember, very strong inverse correlation between stocks and the US dollar. So on this chart, what I'm showing is the US dollar really looking bad over here. This is the first time since the Fed's been hiking rates that it looks toppy. We got a bearish descending triangle, the opposite of the bullish ascending triangle in the S&P, and a little breakdown below that. And here we have S&P futures, and this is the US dollar index in blue, but I've inverted the price to make this a little bit more digestible and easy to see. So this is dollar strength pulling the market down, pulling S&P futures down. Over here, the dollar, it basically is leading the market higher into this rally. So over here, the dollar is still very weak, and it's leaving a lot of room to the upside still for the S&P to rally. So the last time the dollar was here was about August. Last time it was this low, and the S&P was trading around 4,300. Now that's not a price target based on, dollar correlation. It's just to say that there is a supportive environment right now with the US dollar falling. Here is my custom credit index, and what we saw last weekend was just a little bit of a dip. By the way, the other thing here in red and green candles is the S&P. We saw a little dip over here, and that was Friday on that half day, and the market pulled back. So credit led the market. Credit is a great leading indicator. Over here, positively divergent as the market pulled back and led right into that breakout. So if you see over here, Friday, we got the payrolls report, everything dumped, but then again, we see it really leading the S&P higher going into next week. So that's a good signal as well. And here are some 3C charts. So positive divergence right over here into the pullback this week right before the breakout. Looked a little bit weak, nothing too, scary. We had a little triangle here right before the payrolls report. Basically, the market was saying, okay, we're just going to push pause here and wait and see what the payrolls report did. Here's the gap down. Didn't look great Friday morning, but improved a lot as we went through the day. But this is just the short-term, like intraday chart. The one I've really been looking at is the trend chart on a 3-minute time frame. And over here, what you'll see, I'm going to pull up a highlighter, but don't pay attention to the colors here. A negative divergence right here in 3C. This is the start of that correction. So the S&P hit our measured move at 4,000. And the most frequent common thing to happen after a measured move is hit is for price to consolidate in that area. Price consolidated in that area. This is where we got that ascending triangle, and 3C is positively diverging as that triangle is forming. So that is a good sign. And here's the breakout, and this week, so it's confirming, it's maybe even leading a little bit, but the point is it looks good. Let me pull up QQQ on the same chart, and you'll see the same thing. Here's the pullback signal right here. This is the consolidation of bull flag for NASDAQ or for QQQ. And as it's doing that, as it's forming this kind of parallelogram pullback, 3C is moving higher. So that is what you want to see in a bullish consolidation and confirming the breakout. And then here is the diamonds, because the Dow has just been on a rip-roaring rally, like the financial media saying, oh, no bull market because the Dow's up 20%. This chart looks fine. 3C is confirming this is what it should do on a solid chart with no divergences, but I suspect that we see the NASDAQ play a little bit of catch up and the Dow probably underperform a little bit this month. So since I've been mentioning the new website and the fact that the price on the new website is going to go up a little bit, but if you are a current subscriber to Wolf on Wall Street, before the new website goes online, you will be locked in at the same rate that it's been since 2008. So I've had a lot of questions about, what kind of services I provide and all that. So I usually do at least 6 posts a day, sometimes more. I think the most useful one is the early update, which is right after the cash open, sets the tone for the day. The most comprehensive one is the daily wrap. I am going to link the daily wrap from Wednesday. You can check it out. I'll link that in the description of this video. And I'll also link my Twitter stuff, and you can follow me there. There's a subscription bell right down here, or subscription icon. You can hit that and subscribe to the channel. Don't forget to hit the bell, and that will give you updates of when new videos are posted. And if you like the video, please give it a thumbs up, and don't be shy about asking questions or commenting. I'm more than happy to answer those questions for you.